Hi everyone, my name is Phil Blancato. Welcome to the LTAM Asset Management Quarter End Review. Hopefully this video gives you some insight as to our thought process on the markets, where we think the economy might be going, and how we're investing your funds. So let's get right to it. 2016 was an interesting year. As you remember, the performance of last year was pretty good. Our expectations for 2017 were a little lower. The economy just kind of chugging along, things not changing a whole heck of a lot. We call this a Goldilocks economy. Not too hot, not too cold, kind of right in the middle. And the reason being, even post the election bounce, what's been called the Trump bounce, the market really roared on expectations of what might come. But expectations are a hard thing to meet along the way, whether it's the healthcare reform or it's the potential tax cuts that would really impact the market. These things take time to play out. So the first quarter actually worked out pretty well. There was a continuation of that euphoria post the election, especially in those first couple of months of the quarter. Coming into March, things slowed down a bit, but on total, the markets, the stock market specifically, performed pretty well. There's a lot of unknowns out there, whether it's the political environment, the geopolitical environment. Think about problems around the world, whether it's military related or terrorism or just political. Think about the United Kingdom and their desire to leave Europe, what's been called Brexit, or the possibility of the French to do the same thing, which is now termed Frexit. These are all headwinds that the market has to surpass. We call that climbing the wall of worry. Truth be told, when you think about it in whole, why we call this the Goldilocks economy is because, by and large, the U.S. economy is doing okay. Unemployment rate today reached 4.5%. That's a really low number considering the average historical unemployment rate in the United States is 6%. Think about personal income, how much money you earn. It's actually right above 4% right now on an average annual basis because wages are up about 2.7%. Solid numbers. Consumer confidence is doing really well. Most of you believe the economy is actually improving. Things are going along fairly strongly. And our GDP, our gross domestic product, is up over 2% on an average annual basis. So pretty solid numbers. When you think about that on whole, that gets you in a good middle-of-the-road territory. It's not the 4% days of maybe Ronald Reagan, but it's certainly not recessionary when it comes to how much we grow per year. And in those types of environments, when we're modestly growing along, what you get is a sort of modest stock market. Remember last year's numbers on the S&P 500 were pretty good, up around 8% for the year, so a decent year. This year we're already right in that positive territory of right around 6% for the year on the S&P 500. Those are solid numbers. In fact, when we think about the equity markets and we think about where they might be going, we believe that the stock market didn't have much upward strength this year, really predicated on stock market earnings and whether or not the stock market could really take off. And so far, it's really met expectations. In fact, surpassed our expectations. First quarter earnings were solid, up around 5%. So companies earned 5% revenue for the first quarter. They did that with sales and they did that with pure earnings. If that trend can continue, then this year could actually work out to be pretty well. We expected the stock market to return around 6 to 7% for the year. We're just about there. But if earnings continue to be strong, then in fact, we actually could see the stock market go even higher than our expectations. So far, solid. Not blowing out, not killing it, but doing just okay. Well, economically, the data is just fine. When you switch gears and think about international markets, a little different story. We haven't made money in international stocks since 2005. Emerging markets have times look great and have times that just look really badly, like last year. So there's been these moments of opportunity there, but not consistent. The first quarter proved to be somewhat of consistency for international markets and emerging. International, specifically Europe and Japan, have had lots of headwinds. They have high levels of unemployment, high levels of debt, and they've been struggling to get their economies going for years. But truth be told, for the first quarter, they did a little better. Their manufacturing data came in a little bit more positive. Their unemployment went down a bit. They still have over 9% unemployment, but slightly better. And their bank, their federal bank, they're all like our Federal Reserve, their Federal Reserve called the ECB, is being very accommodative, printing lots of cash to try and get lending going. It's working a little bit. So international, which we have a little bit in the portfolio, has been a big plus for the portfolios. Emerging markets struggle with the U.S. dollar. In the first quarter, the U.S. dollar went down, and that helped emerging markets. And then there's been a resurgence in the desire for commodities. The globe is growing a bit more. So because of that, there's a higher demand for commodities. They also have younger populations there. Young populations who buy goods and services, coupled with the higher commodity demand, emerging markets have done pretty well for the first quarter. They're always volatile, but they make for an interesting aspect of the portfolio. We own just a little bit in our most aggressive portfolios. Fixed income. fixed income's been in an unusual place. We saw the 10-year Treasury yield go above 2.6% in January. Now it's back down to 2.3%, give or take. That's pretty unusual to have these wild swings of volatility. Post the election, where we were at roughly 2.3%, we skyrocketed up, and now we've come back down. And the reason being, the U.S. bond market is the strongest bond market in the world. Many of the global bonds out there earn significantly less rates of interest rates. So even though our Federal Reserve is trying to push interest rates higher, our bonds are staying very much constrained. Why? Because as the Federal Reserve raises interest rates, because our economy is doing okay, other places in the world like to buy our bonds because, for example, the 10-year U.S. Treasury bond yields 2.3% as of today, versus a German 10-year bond yielding 0.10. Which one would you rather have? And for that reason, our interest rates are volatile because we've got compelling forces pulling them higher and lower, but certainly better off than the rest of the world. We don't think interest rates go much higher because of, one, demand for them, and two, we don't think the economy is strong, but not strong enough to get us much above 2.5% to 3%. So bonds are basically going to do what they're going to do. They're up slightly for the year. We don't have very high expectations for bonds. We think we'll make a little bit of money there, but not a whole heck of a lot. So when you roll it all together, you really got to focus on two things. One, in this Goldilocks environment, how are we doing? Well, we're doing okay. The economy is trudging right along. Not terrible, not recession-like, not going negative, but just doing okay. And an okay environment needs probably 6, maybe 8% returns on the stock market. If we really get lucky and earnings get stronger, maybe 10%, and maybe get stronger because you, the consumer, buy a little bit more. And then the bond market, we have very low expectations, 1% to 2% this year. So not recessionary, but a solid general economy with quality overall returns in your portfolio. The other part of it that we want to keep an eye on is the political environment. If, in fact, some of the proposals coming out of Washington come to bear, specifically tax cuts. Tax cuts could have a big effect on the overall health of the stock market and the bond market. Corporations will make more money if they pay less taxes, and that will drive stock market prices higher. So that's something we're watching closely. We call that the Trump pivot. If, in fact, tax legislation, deregulation, healthcare changes go through, which would make corporations earn more money based on that, that could be a boon for the market. Hasn't happened yet. There are projections that it's going to happen at some point. We just don't know when yet, and for that, we're monitoring it closely. Hopefully this video gave you some insight as to what we think is coming and where we've been. We appreciate the time you've taken to watch it. If at any time you have any questions or concern, give your financial advisor a call. They will grab us. We'll try and answer your questions about the economy, about your portfolio, and most importantly, thank you for the trust and confidence you've placed in us. Enjoy the spring. It's finally warming up in here in New York, and maybe I'll get to meet some of you real soon. Thank you. Have a great time, everybody. Take care.